Hello everyone. Let me introduce myself. My name is Ranti Retnowulan with NPM 234120021 from Act 23A. In this video, we will discuss common size analysis, from its definition function to its benefits in the business world. Come on, watch until the end. Common size analysis is a financial statement analysis technique that converts each figure into a percentage of the total of its main group. For example, in the income statement, each item, such as cost of sales, operating expenses, or net income, is expressed as a percentage of total sales. In the balance sheet, assets, liabilities, and equity are expressed as a percentage of total assets. The main purpose of this technique is to make it easier for us to compare the structure of financial reports between 1. Different periods in one company, 2.2 or more companies of different sizes. In other words, we can see the proportion or composition, not just the absolute numbers. Here are some of the main functions of common size analysis. A. Comparing between periods using percentages, we can see how the financial structure has changed from year to year. For example, are operating expenses increasing or decreasing as a percentage of sales? B. Comparing between companies, company size is no longer an issue. Even though Company A is bigger than Company B, we can still compare the efficiency or cost proportion of both fairly. C. Detecting trends and anomalies, we can see if there are significant changes in the report structure. For example, a sharp increase in marketing costs which could impact profits. D. Cost efficiency analysis. Are production costs or administrative costs too high compared to revenue? Common size analysis can help us find out more quickly. So, what are the practical benefits of common size analysis? Here they are. Makes it easier to understand financial reports by looking at it in percentage form. We can more quickly understand the structure of a company's income and costs, even for non-accountants. Assists in managerial decision-making. Management can use this data to determine efficiency strategies, cost allocation, and budget planning. Assess company stability. If the proportion of expenses and income remains stable over time, this can indicate good management and business stability. Facilitates analysis and auditing. Financial analysts and auditors can detect unusual deviations, such as a significant increase in administrative costs without any clear reason. Let's look at a simple example. In 2024, the company's sales are 1 billion Indonesian rupiah. Salary costs are 200 million Indonesian rupiah. This means that salary costs are 20% of sales. In 2025, sales increased to 1,200 million Indonesian rupiah, and salary costs increased to 360 million Indonesian rupiah. So salary costs become 30% of sales. From this, we can conclude that even though sales are increasing, salary costs are increasing faster. This could be a sign of inefficiency or the need for a new strategy in HR management. So, financial friends, that is our complete discussion about common size analysis. By converting financial statements into percentage form, common size analysis provides a simple yet effective way to understand a company's financial condition. We no longer just focus on the big numbers, but can also see the structure and efficiency behind those numbers. This analysis helps in comparing between years, between divisions, and between companies of different sizes. For business owners, it is very useful to assess whether the cost strategy has been right so far. For investors, common size helps to evaluate whether the company to be invested in shows a balance of costs and income. And for accounting or finance students, it is an important basis for understanding how an analyst thinks. It is important to remember that common size analysis is not a substitute for financial statements, but rather an important tool to simplify and clarify the information available. When combined with financial ratios, trends, and other vertical/horizontal analysis, the results are much more powerful. So, from now on, don't just read the big numbers on the financial statements, convert them into percentages, analyze the comparisons, and see the story behind them.